Welcome to CoreLogic's Housing Market Update for December 2024, brought to you by First National Real Estate. As we move into the last month of the year, the housing market's setting up for a relatively weak start to 2025. Our National Home Value Index rose by just 0.1% in November. That's the smallest monthly rise Australia-wide since January of 2023. This marks the 22nd straight month of growth, but if the easing trend continues, it could be close to the last month of growth in this cycle. The downturn is gathering momentum in Melbourne and Sydney, where negative movements in values will weigh on the national index due to their size. On a rolling quarterly basis, we're now seeing 4 of the 8 capital cities recording a fall in values, led by Melbourne and joined by Darwin, Sydney and Canberra. The mid-sized capital cities and most of the regional rest of state markets continue to provide some support for growth in the national index, but it's clear that momentum is also leaving these markets. For example, Perth's pace of capital gain continues to lead the nation, with values up 1.1% over the month and 3% higher over the rolling quarter. However, this was the softest rise over a rolling 3-month period since April of 2023, and it's less than half the rate of growth recorded through the June quarter at 6.7%. Similarly, Brisbane's quarterly rate of growth has eased back to 1.8%. That's the slowest pace of gain since March of 2023, while Adelaide's 2.8% rise in values over the past 3 months was the smallest outcome since June of 2023. Outside of the capitals, the regional housing trends have been a little stronger, with a combined regional index rising 1.1% over the past 3 months, compared with a 0.3% lift across the combined capitals. That being said, like the capital city trends, there's a significant level of diversity, with regional Victoria weighing on the headline numbers, down 0.9% over the rolling quarter, while every other rest of state region continued to record a mild rise, led by regional WA, up 3.3%. Weaker housing conditions have been accompanied by an increased level of supply, with vendor activity lifting through spring. Based on the volume of houses and units advertised for sale over the 4 weeks ending November 24th, capital city listings are up 16% since the end of winter, with Perth up 33% and Adelaide up 25%, recording the largest lift in advertised stock levels through the spring season, albeit from an extremely low base. Despite the substantial rise in advertised stock levels, total listings remain well below average in these cities. Sydney and Melbourne listings are now tracking 10.4% and 9.1% above their previous respective 5-year averages, to be at their highest level for this time of the year since 2018. At the same time, purchasing activity looks to be winding down. CoreLogic's estimate of capital city home sales over the past 3 months is 4.6% lower than a year ago and 2% below the previous 5-year average. The largest drop in the volume of home sales has been in Sydney, where sales over the rolling quarter were estimated to be 15.4% lower than a year ago and 15.1% below the previous 5-year average. With more available supply and less purchasing activity, selling conditions have deteriorated through spring, meaning buyers are firmly back in the driver's seat. The combined capital cities auction clearance rate has held below the 60% mark since mid-October, and median selling times are trending higher for private treaty sales. On the rental market, CoreLogic's National Rental Index has continued a relatively flat run of growth, rising by just 0.2% in November to be 5.3% higher over the past 12 months. This annual change in national rents was the smallest since April of 2021. A year ago, rents were increasing at the annual rate of 8.1% and by more than 9% over the prior 2 years. But at 5.3% annual growth, rents are still rising at more than twice the pre-pandemic decade average of 2%. But given weak monthly change, the annual trend is set to slow further from here. Rental appreciation is slowing across most markets due to a combination of lower population growth, especially with less net overseas migration, but also a gradual recovery in the average household size, which is helping to moderate rental demand. Now let's take a tour of the housing markets across each of the capital cities. With values flattening in September and falling in October and November by 0.2%, it looks like Sydney's housing cycle has turned. The 2 consecutive months of decline follow a 16% rise in values since the cycle commenced in February last year. Sydney houses are driving the weaker outcome, with values down 0.8% over the past 3 months, compared with a 0.4% rise in unit values over the same period. Similarly, the upper quartile of the market is leading the weaker conditions, with values falling 1.6% over the past 3 months, while lower quartile values are showing a subtle rise, up 0.9%. Melbourne's housing market is continuing to navigate a relatively mild downturn, with housing values falling a further 0.4% in November to be down 2.3% over the past 12 months. Values are now 5.5% below their record highs set in March of 2022, and they've risen by only 12% over the past 5 years, which is roughly a third of the growth recorded across the combined capitals at 38.3%. Both house and unit values are trending lower, but it's the house sector recording the larger declines, down 1.2% and 0.7% respectively over the past 3 months. Similarly, it's the upper quartile of the value spectrum that's driving the largest falls, with Melbourne's most expensive quarter of the market down 1.4% over the past 3 months, compared with a 0.5% fall in values across the lower quartile of the market. Brisbane's housing market has continued to rise in value through November, with the monthly change holding at 0.6% over the past 3 months, which is half the rate of growth recorded a year ago. Although values are rising, growth conditions are slowing as affordability constraints bite and listing numbers rise, up 5.6% compared with the same time last year. Unit values have been rising at a much faster rate than house values across Brisbane consistently since December last year, rising by a cumulative 18% over the past 12 months, while house values are up a smaller 11%. Adelaide housing values rose 0.8% in November, a strong result, but the second month in a row where the monthly gain has been less than 1%. The market is clearly losing momentum as listings rise. They're up 25% since the end of winter, and affordability constraints become more pressing. The strongest conditions are skewed towards the most affordable areas of Adelaide, with Salisbury and Playford both recording a gain of approximately 19% over the past 12 months. Unit values are continuing to rise faster than house values, up 18.0% and 13.4% respectively over the past 12 months. Perth is continuing to lead the capital cities for the rate of growth in housing values, with the market up another 1.1% in October, adding approximately $8,460 to the median dwelling value over the month alone. Although the pace of growth remains strong, the quarterly trend has more than halved since the June quarter, from 6.7% to 3% over the 3 months ending November. Slower growth has been accompanied by a rise in listings through spring, with total advertised supply up 33% since the end of winter, the largest increase in listings across the capitals through spring, albeit from an extremely low base. The downturn in Hobart home values looks to be levelling out, with dwelling values up 0.2% in November to be 0.4% higher over the past 3 months. Although the annual change is still negative at -1%, the rate of annual decline has eased from a 1.4% drop over the 12 months ending August. The subtle improvement in housing values has been accompanied by a trend towards fewer homes on the market, with listings down 13.2% relative to the same time last year, but still 22% above the previous 5-year average. Darwin housing values nudged a little higher in November, up 0.2%, but the trend remains relatively weak, with values down 0.7% over the past 3 months, and the annual change was just a bit better than flat, with a mild 0.9% rise. Darwin remains the most affordable capital city by some margin, with the median house value at $580,000 and a median unit value of $364,000. The affordability reflects a weak long-term cycle where house values remain 4.4% below the record highs set back in 2014, and unit values are still 15.1% below peak levels. Canberra home values were virtually flat in November, nudging 0.1% higher, but the trend remains weak, with values down 0.3% over the past 3 months to be 0.1% lower over the year. The unit sector remains the main drag on the headline growth figures, with values down 2.9% over the past year, while house values posted a 0.7% rise. In terms of the outlook for housing markets, this has arguably deteriorated over the past month, with core inflation holding high, labour markets remaining tight, and the chances of a rate cut early next year becoming less likely, not to mention the rising geopolitical risk. The October inflation indicator came in at a healthy 2.1% for October. That's well inside the RBA's 2 to 3% target range. But we know the RBA will be looking through the headline results and focusing on the core inflation outcome. Unfortunately, the trimmed mean moved in the wrong direction in October, nudging higher to 3.5% from 3.2% a month earlier. While the monthly inflation indicator doesn't provide a complete read on CPI, it's a reminder that the last mile of getting inflation sustainably within target remains a challenge. Financial markets are pricing in a rate cut around the middle of next year, while economists from the big four banks are expecting rates to drop sometime between February and May. Until interest rates come down, it's hard to see the weakening housing trend turning around. A lower cash rate will be a positive factor for housing markets, providing a lift to borrowing capacity, and along with lower inflation, we should see an improvement in serviceability assessments and support for a further rise in consumer sentiment. A couple of rate cuts might be enough to shore up a declining trend in home values, but it's hard to see any material upwards pressure returning until interest rates reduce more substantially and affordability barriers become less formidable. Alongside the uncertain economic outlook, housing markets are likely to be arriving in 2025 on a relatively weak footing, with value growth losing steam or falling, advertised stock levels rising, unaffordability at record highs, and demand no longer keeping pace with the flow of new listings coming to market. There may be some exceptions emerging through 2025, with consumer sentiment recording an increase in buyer confidence across Victoria. In Tasmania, where home values have been flatlining for the past 2 years, home sales have trended slightly higher through spring relative to a year ago. Rising levels of geopolitical risk add to the uncertainty of the 2025 outlook, including wars in the Middle East and Ukraine, as well as the implications of a new Trump presidency yet to become clear. Additionally, a federal election is just around the corner, which is likely to feature housing policy front and center, adding to the complexity. An undersupply of newly built housing is likely to provide some support for housing values. Although population growth is expected to ease further in 2025, a cumulative undersupply of housing has accrued across Australia following the record levels of population growth since international borders reopened. The residential construction sector continues to face feasibility hurdles in getting new housing stock to market, with materials and labour costs having surged over the past 5 years. Construction costs aren't rising anywhere near as rapidly as they were through the pandemic, but they're still increasing at around 1% a quarter. Significant competition from major public sector infrastructure projects is likely to keep prices for labour and materials high across the residential construction sector for 2025. Given the highly ambitious target to build 1.2 million new homes by mid-2029, the potential for new supply-side stimulus policies aimed at kickstarting residential construction activity is highly likely in 2025. With this being our final market update for the year, I'd like to wish everybody a safe and happy festive season. The housing market tends to take a breather from mid-December through to late January, and our next update will be out in early February. In the meantime, you can keep up to date with all the property sector goings-on at the news and research pages of the CoreLogic website.